I'm joined now for the expert's view by Anthony Thomas from credit rating agency Moody's. Anthony, welcome. In yesterday's report, you talked about how there's a kind of a higher than expected concern about debt, about sovereign debt. Why do you think the markets are so nervous about it? After all, we've known it's been around for some time.
I think the market's focus has changed this year. Last year, it was all about supporting activity, preventing a depression. That seems to have been successful. The focus now has switched on exit strategies. Governments ran up huge amounts of debt to support activity during the downturn, which is fine during the downturn, but how are they going to get out of this fiscal hole when the economy starts to recover? That's the real question for the markets. They've built up this huge amount of debt. How are they going to run it down?
Now, obviously, the attention today has been on Greece. Moody's has actually said that, a default is very unlikely in any of these countries that we're concerned about, the other southern European countries as well. Liquidity is normally not an issue. But you talk a little bit about it being self-fulfilling, that the more nervous the markets get, there is now a threat of an illiquid situation. How worried are you about that?
In point of fact, we're not that worried about it. If you look at the experience, the fears that governments won't be able to raise the money they need have always been exaggerated. Greece, for example, had a very successful auction just last month. But there is this risk, this danger, this fear that if other investors fear that the debt won't be bought, then they won't buy it either.
And you create this spiral.
Exactly. I mean, we're quite confident that some sort of support will be forthcoming from the EU. Therefore, this won't materialise, but inevitably it is a risk.
Looking at the EU today, we can see them struggling to Brussels there in the snow at the top of our programme this morning. What are you expecting to find today? What will calm the markets?
Well, what we're really looking for from the ratings agency's perspective is the conditions of any support to Greece. They've come up with a package to deal with their fiscal problems, which on paper looks extremely encouraging indeed. And if it were implemented, it would address really most of the concerns that the market has. The question is how much of that package is going to be implemented. The more conditions that are attached to any support from the European Union, the greater the chances of that package being implemented.
So you will be watching, obviously, at Moody's over the coming weeks to see if there are notches, if you like, if there are actually things that we can point to that are concrete, or we can see that the deficit is coming down, or that whatever is implemented by the European Union today actually takes place.
That's right. I mean, we've got a negative outlook on Greece, which means that on balance we think that the next move in the rating is downwards, and we think that because we don't actually think the package is going to be implemented in full. What we don't know at the moment is how much of the package is going to be implemented. The conditions which are attached to any support will give us a very good indication of how much of the package is likely to be implemented.
Now, also negative on Portugal. What are your thoughts there?
Well, I must say straight away that, as we say in the report, Spain, Portugal and Greece may share the same currency, but they don't have the same credit profile. There is a similar problem in Portugal in that it also has a large budget deficit that it needs to get under control, but the problems are much more acute in Greece than they are in Portugal. In Portugal, what we're looking for is a credible plan over the next several years to bring the deficit under control. We're looking for their stability programme update. At the moment, we are sceptical, simply because of the politics in Greece, that they will be able to bring the deficit down sufficiently quickly to maintain their current rating.
Now, looking at Spain, you're more positive on Spain, and you said it should maintain its AAA rating. Why is it different?
Well, I think the key thing about Spain is that when we look at their budget deficit, we can see how they will get it under control. In fact, the Spanish authorities have been quite explicit about how they're going to bring it down. They haven't costed it to the last euro, but we've got as good an idea as we can realistically expect to have of how they will reduce their deficit. And as a result, we think that their AAA rating is much more strongly supported.
Anthony Thomas from Moody's, thank you very much indeed for joining us today.